All right, hello everybody. Welcome to How to Grow or Preserve Wealth in an Uncertain Economy. It is Wednesday, June 4th, and we are glad you are here. My name is Albert. I'm the founder of Albert's List. We're a job search, side hustle, and AI education company hoping to make you more indispensable in your job, whatever it is that you do. Today here we have Robin Patin. She's a certified financial planner, right?
hmm
And she's also my financial advisor, and she's somebody that I look to often for financial advice and to make sure that I'm doing all the right things in the market. I brought her in here today because I know it is an uncertain time for many of us as we look through the state of the market and as we figure things out. So she's going to talk a little bit about everything that you need to know about your money in this economy and how to make the most of it. Remember, everything that you are also about to hear is not financial advice, but rather information that you can use. May not necessarily reflect your situation until you build a relationship and become an official client of Robin's. Again, also, this webinar is being recorded and will be put on our YouTube channel so you can reference it later. Robin, I hope I covered everything there. I'm going to go ahead and hand it over to you.
Okay, thank you, Albert. Albert and I go way back. I've known Albert for about 15 years, and I really respect his work with this group and respect him in general. So thank you, Albert, for giving me an opportunity to connect with your community again. So I'm going to share my screen and pull up some slides. I just have a few slides, so this should go pretty quickly. Hold on. Let's see. Okay. Okay, can everyone see my screen? Okay, so I'm just going to move forward and assume that everyone can see my screen. This is who I am. I have about 8 years of experience as a financial advisor, and I work for an organization called Corio Advisors. I'm a certified private wealth advisor and certified financial planner. My office is in Orinda, and I live in San Francisco. That's just my email, my website, my YouTube. My YouTube is Your Rich Auntie and my LinkedIn. So that's how you can locate me if you have additional questions after today's presentation. Okay, so what the heck is happening in 2025? So 2025 has been a wild ride due to the current administration's economic policies. I've been doing this for almost a decade. I've been through pandemics. I've been through one Trump administration. I've seen a lot, and 2025 has just been off to a bang. And it's all self-inflicted and all due to the current administration's economic policies. We've had Doge, which created massive government layoffs. We have possible tariffs. We're still waiting to see the outcome of that. We've had economic business cycle uncertainty. Most businesses operate in a space 12 to 18 months in the future. And with all the recent current administration's economic policies, it's virtually impossible to forecast accurately the next 6 months, let alone the next 12 to 18 months. So we've seen a lot of economic uncertainty built in to that. Now we have tensions with a lot of long-term allies and trade partners. We've had a shrinking GDP for Q1 2025, and I remind you that the definition of a recession is 2 consecutive quarters of GDP shrinkage. We're already halfway there, technically. Today, the private sector hiring news for May 2025, there's only a growth of 37,000 jobs, which is coming in a little bit under projections, which kind of raises a yellow light. And all indicators are saying that the economic uncertainty has already put us into recession. Recession is a backwards looking indicator, not a forward looking indicator. And there are some signs that the US economy is already in recession. I have seen it as a financial advisor. Wallets are closing. Deals have come off the table. Houses are not being closed on. Business deals have come undone simply because people are scared. And when people are scared, wallets and purses tend to close. Okay. So what is next? And I will be perfectly honest, as a financial advisor, we have no idea. This is one of the first times as a financial advisor, I can honestly say that it's really difficult to predict what's going to be coming up over the short term and the long term because the current administration's economic policies are so unstable that it's really hard to predict the future. There's a prediction that there's possibly two interest rates cuts coming by the end of the year, but with a dimming jobs report, I don't know if that's really going to happen. We do expect the tax bill that's working its way through Congress to to pass, and many of the tax bills laws are basically aimed at cutting programs that help poor and working class Americans. It's still unknown whether tariffs are actually going to come to pass, and we do expect that 2025 will continue to be a volatile year in the stock market. So, what should we all be doing? So, if you have a job, I would quickly as possible pay down consumer debt, credit cards, and car payments. Student loan payments are back as of May 2025. Don't do forbearance, deferment, or income sensitive payment. It's a trap. I've said this countless times. I've had clients get caught up in this. But when you're in forbearance, deferment, or income sensitive payments, you get into a negative amortization situation where the balance of the loan can grow over time. I know it's a beast to pay back these student loans, but the best way is just to pay them back on terms, whether it's 10, 15, or 20-year payments, and just never miss a payment. So don't try to go with forbearance, deferment, or income sensitive. Building at least 6 to 8 months of living expenses and savings. Now, remember, this is not 6 to 8 months of paychecks. This is 6 to 8 months of living expenses. So your living expenses hopefully are less than your paycheck. So it may not be quite as much money as you think. If you have stock options, this may be a good opportunity to exercise stock options while the market is in a good place and generate some cash for savings and to pay off debts. Try to hold on to that job. I know that people in the recent past have been changing jobs a lot, but it may be time to really sit tight in your job unless there's something absolutely dysfunctional about your jobs. But there may be fewer and fewer opportunities on the horizon in the coming months. And also think longer and wisely about new expenditures, things like vacations, new cars, if you have debt and haven't built up your savings yet. Okay. So if you're searching for a job, corral your cash from all accounts and place it in a high yield savings account. I'm always surprised by how many clients have cash here, there, and everywhere. They have it across five different accounts, including investment account. But if you're searching for a job or you've recently lost your job, it's time to kind of corral all that cash and put it in one place so that you can access it. Can you negotiate a severance? If you're leaving under a contentious situation or under a question mark, don't sign away your rights for a severance. Make sure that you visit doctor, dentist, optometrist while you have your benefits. And debts, if you have credit cards, can you call and negotiate a lower interest rate? It typically requires a good history of payment and good credits, and you may be able to get a lower interest rate to pay back whatever debts you owe. Cars, do you even still need a car? A lot of people have a car only to go to work, but if you no longer have the job, you may be able to sell the car and go car free for a while. Stocks, once again, the market is at a good place right now. If you have stocks or stock options, it may be a time to sell some of it and get funds for living expenses. And technically, if you have a Roth IRA, you can take money out of a Roth IRA up to basis, but I don't recommend doing it. But if push comes to shove, bad comes to worse, and you need money, you can rely on the Roth IRA and there is an asterisk there for a reason. Okay. So financial advisors, people often ask about my work as a financial advisor. Typically, when a person gets to investable assets of 100,000 or more, and they don't want to be a do-it-yourselfer, that's the time to bring in a financial advisor. But I really strongly advise people when they're starting out to do it themselves because you need to understand the basic mechanics of how things work and how investing work. And it's good to get that experience yourself. Of course, if you have a sudden change of circumstance, an inheritance or lottery win, definitely give me a call. And people ask how advisors are compensated. We're compensated with assets under management or hourly. I work assets under management. Assets under management basically gives you a percentage, let's say 1%, that's broken down quarterly. And so it's 0.25, 0.25 through 4 quarters. Hourly, it's based on a set project and a set number of hours that you need work done. They have financial advisors that either they're typically are either or it's rare that you encounter a financial advisor that's both, but they are out there. And people ask about YouTubers. I am a YouTuber myself. There's a lot of YouTubers giving a lot of advice. A lot of it is terrible advice, and be careful of people who give you shortcuts. There really isn't very many shortcuts out there for building wealth, but these are the YouTubers who I recommend. Our Rich Journey, it's about a couple, husband and wife, two kids. They worked for the federal government, never earned six figures, but over a period of 20 years, they saved over $1 million or invested over $1 million and retired by the time they were 40. The Money Guys, this is a CFP and an accountant who they do a really great money show. Ramit Sethi, I'm sure most of you have heard that name. He basically does financial coaching and he's really good at it. Your Rich BFF, she is a young woman. She's maybe a little bit younger than me. She worked on Wall Street for many years and she is big on TikTok and YouTube Shorts, and she gives really good advice in 30 seconds or less. And myself, Your Rich Auntie, you can find me on YouTube under that moniker. Okay, so I'm going to stop sharing my screen and we're going to open up the floor to conversation. And Albert, are you?
Yep, I'm here.
Okay. All right. So if you want to like monitor the conversation, if people want to ask questions, the only questions I can't answer, I will tell you if I don't know the answer to it. I'm very honest, but I can't give any recommendations about stocks, bonds, mutual funds, and I can't recommend any products because I'm a licensed financial advisor and they don't like us doing that. But other questions I can try to answer them.
Yeah. So if you have any questions, drop them in the webinar chat and or use the Q&A. I'll be watching for that. Um, in the meantime, I think while that question comes in, do you have any recommendations for what kind of high yield savings accounts people should look into, or just put it in there and just hope to ride it until you need the money?
Well, you want the money to be accessible, but not too accessible,
Hmm.
right?
Yeah.
Typically with like Barclays or American Express, there's some layer of separation. Like it's at least 24 or 48 hours before it gets over to my actual functioning checking account.
Yep.
So sometimes having that layer of separation can be a good thing because it gives you time to stop and think.
Yep.
So for people who may be a little bit more impulsive with money, look for a high yield savings account that has is accessible but not too accessible. And it's not like you can go into an American Express office or a Barclays office and get your money out, right? You really have to just do the online thing and just wait.
Yeah.
Also, people ask me about putting money in CDs for their savings. I don't recommend it. I don't recommend it because CDs, even short-term CDs, oftentimes they automatically roll over. And if something goes left, right, you lose a job or something, you could be caught in a cycle of trying to unwind a CD, and that can be difficult and expensive, depending on where the CD is held.
Yeah. We have a question. I've been at my current position for almost 2 years. This doesn't cover my monthly expenses. How can I easily supplement my income without having to change jobs?
Hmm. I'm hearing this a lot, and a lot of it has to do with inflation. Like since 2019, we've seen about 25% inflation, and in some areas like education, healthcare, inflation has been even more. So a lot of salaries that were once sufficient are just no longer cutting it. And unless you've changed jobs, changed careers, or made some substantial, changes in your work life, your salary may not have gone up 25%, right? And so I'm seeing this more and more among pretty well-paid people who have good jobs. And I want to acknowledge that this one is tough. The only way you're going to get by is either cutting expenses, and we live in a high cost of living area where you can only do so much. If you don't want to leave your current position, they're not going to promote you or they're not going to give you an increase because that would be the natural thing, right? If you can make a lateral move up or you can make a move up in your organization to the next level and get more money that way, that would help you out. But sometimes that pathway is blocked. Second jobs, it's hard because working one job in America is hard, it should be sufficient and is hard enough, right?
Right. Yeah.
right? But oftentimes it's down to a second job. If you have a hobby, an interest, a passion that you can monetize, that's the quickest and best way to do it sometimes. Albert and we were having a conversation about YouTube. And I was saying, I monetized my YouTube channel. That was a long, hard slog to monetize social media. And I'm just trying to basically get back to zero at this point. So sometimes things like social media, there could be a lot of investment to get to break even on social media. But yeah, if your employer will not promote you, you don't want to leave, you can't lower your expenses. Working an additional job is probably the next logical thing, as much as I hate to say that, but this is common. This is common. And I supplement without having to change jobs. Geez. Is there like something that you can do to put yourself in line for promotion? Like, is there additional education, additional training? Someone's leaving or something that can move you up if you want to stay in the same organization. So that's how I'm sorry, I don't have the perfect answer. I wish I had the perfect answer for that one.
While they answer, I'm going to ask the other question, which is, how does a high yield savings account compare to a money market fund with daily availability?
Sure. So typically a high yield savings account will pay you a little bit more than a money market. I mean, even like the clients who I have, I have a money market and I have clients with money market. It takes me anywhere from 24 to 48 hours to unwind it from the money market to make it available to the client. So some money markets are not instantly available. You have to unwind it. But typically, if it's instantly available, there's a slightly lower interest rate than a money market that has to be invested or a high yield savings account. It's usually negligible. So, I mean, if you need that money immediately, it should be in a more liquid form.
Got it. Okay. Um, Another question. So it takes a lot longer for people to find a job these days. I've read anywhere from 6 months to 8 months and beyond. Let's say you start running out of money at the 5 to 6 month range, which I think is what you recommend for savings. At
Mhm.
that juncture, what do you recommend that people do?
Sure. So, it's typically 6 months, but for some people, I do recommend more. Like, for example, I have artists in my book of business and musicians. They typically need a year, right? Because their income stream is so irregular. An artist may sell four paintings a year and that's it, but they sell for like $40,000 each. And that's that person's yearly income. And then, the next year they may sell four more paintings. So for people with highly irregular incomes, it may be more than 6 months. If you get to that point where you're starting to run low on money, that's when you really have to start shaking the piggy bank and start getting creative. Like a lot of people don't know that you can take money out of a Roth IRA. I don't suggest it, but you can remove the basis. But you have to be able to prove that what you're removing is basis and it's not penalized, it's not taxed if you can remove the basis, right? But you have to be able to prove that what you're removing is basis, which can be really hard for some people. Um, I don't like telling people to do this, but occasionally people have used credit cards, especially when they were getting like those low interest offers in the mail,
Hmm.
and you need it just for a month or two. You're in the closing deal for a job and you just need the next 2 months until you get your paycheck. That may be an option. Bank of mom and dad. Maybe the option if your parents are generous enough to extend a loan or to give you money, that can be an option. People have also done short-term loans from their traditional IRA accounts or their traditional 401k accounts. I don't like doing it because it's very messy. I've only done it a handful of times where it was like a life or death matter. But those are all kind of the last resort efforts that you can make to tide you over until you get a contract in place and you get your first paycheck.
Gotcha. Okay. So yeah, I mean, yeah, it sounds like going into your retirement account is generally not the most ideal, but if you have to do it, then you have to do it, right?
Yeah, I mean, it's good that we have that option of accessing a Roth IRA basis before we turn 59 and a half. But it robs the account of long-term growth to take money out. It's not like you can take it out and just put it back in when you're done. Once it's out, it's out. But I mean, I've been in those positions myself. Lord knows I've been in, 2 months before I get my first paycheck, and it's all bad decisions, and you just have to choose one bad choice and go with it.
Yep. Yep. Another question that I have, I think, is going to be more on the retirement side of the house. The Alberts List audience, is not as young as it used to be, and so how do we think about retirement these days from a when to take Social Security standpoint? It's crazy that I even think that, I'm in my late 30s, but I'm starting to think about that only because, you see everything from people retiring at 62 to wait until they can get the full benefit at 70. What are your insights and your perspectives on that?
Sure. So I deal a lot with retirees in my book of business, and one of the questions is when to take Social Security. I think it's going to be a completely different conversation for me and you, right? Because Social Security will likely dramatically change it has to, or the program will no longer be viable. So, Albert, when you're 62, you're likely going to be having a very different conversation
Yeah.
about your Social Security.
Yeah.
So, as it stands today, a lot of Americans take Social Security at 62 simply because of ageism in the workplace. Like people think they're going to work until 65, and it just doesn't work out that way, right? They're laid off, they're pushed out, they have medical issues, they're taking care of family, something goes left, and people are often pushed out in their early 60s. So a lot of Americans don't have adequate savings for retirement, so it forces their hands to start taking Social Security at 62,
Mm.
right?
Yep.
So what I try to work with my clients on is that they're not in that position, right? Even if they lose their job at 62, they have money somewhere in a or IRA, 401k, Roth account that can hold them while they wait on taking their Social Security. The problem with taking the Social Security at age 62 is that you really can't work anymore. So it's not like you can draw your Social Security and go back to work. You can earn income, but it's a very small amount of income, right? So unless you really are ready to leave the workplace 100% at age 62 and never go back, I really advise waiting longer. I usually ask people about longevity in their family. Like if someone tells me everybody in their family is dead at 70, you're taking it at 62, right?
Yeah.
If you tell me everybody in your family lives beyond 90, you're going to wait until 67, probably until age 70 at that point, right? So there's a lot of factors that go into it, but a lot of Americans do take it at 62, not because they want to, but because they've been forced out of the workplace because of ageism, and they really have no way of getting back into the world of work. They would prefer to be working.
Mm. What's your opinion of using a home equity line of credit or an HEI to utilize for funding life's complexities, needs, and expenses?
So I'm not a huge fan of using a home equity line of credit. I mean, if something really goes left and it's the only thing available, you got to do what you got to do, right? But it's hard because, especially if the home is paid off, you're putting your home on the line to
Mm.
deal with whatever you're dealing with, right? And it's hopefully you'll be able to pay it back. Hopefully it's not the end of the world. But if something really goes out there, and you can't get it back on track, you could lose your home for a relatively small debt, right? If you take out a $20,000 loan and can't pay it back, you can lose your $500,000 house over that $20,000 loan. So I always urge caution when doing home equity lines of credits
Mm.
because you are putting your home on the line for whatever you're dealing with. But I also understand that sometimes that's just it's the only option available.
Yeah, makes sense.
Hmm.
All right, any other questions? What other loan or money making programs or ways? Oh, here we go. I was going to say any other programs to just like take money out of anything is there? available out there. But I'm also curious for this other question. In
Okay.
the current high interest and inflation environment with all the geopolitical instability, how should one work with long-term asset allocation in their early 30s?
Yeah, this is a tough one. I've gotten a lot of questions like this from my clients in their 20s and 30s. Essentially, financial advisors, for the most part, are staying the course, right? We can't make changes according to what Donald Trump is doing, and we don't know the long-term picture of how everything is going to shape up, right? People have been asking me about the viability of the dollar as the world's currency. You know, it's definitely taken some knocks and pings, especially over the past 6 months. Donald Trump's economic policies are kind of weakening the image of the dollar in the global mindset. Um, there's no other form of currency yet that can replace the dollar or act as a strong competitor to the dollar. So for the foreseeable future, the dollar will still be the world's currency. Um, if someone's in their 20s, 30s, I'm still doing either 100% equity or maybe an 80-20 split. I haven't changed off of that because these people have a long way to go. And sometimes my biggest value of a financial advisor is talking people out of selling.
Mm.
Around April 7th, 8th, 9th, I had a lot of conversations with a lot of people to stop them from selling. And it's very fortuitous that I did because the 10th, 11th, 12th had some of the biggest gains in the market in a very long time. A lot of people don't realize this, but a lot of the best days in the market are adjacent to the worst days in the market. And I can't tell it, as much as I do this work and as much experience that I have, I can't tell when a worst day is going to happen, when a best day is going to happen. So if you take money out of the market, I can't tell you when to put it back in, right?
Right. It's all
So,
about time in the market versus timing the market, as
right,
you keep on hearing.
right. And I've done this work for almost a decade. It's absolutely 100% true.
Yeah.
Like I said, some of my biggest value as a financial advisor is talking people off a ledge. And I've done a lot of talking through pandemics, through, wild presidential administrations with completely crazy economic policies during, periods of strong market drops, telling people to stay the course. During a sharp market drop, that's not the time to really in some cases, you do make adjustments, but a lot of times that's not the time to make adjustments in people's portfolio.
Yeah.
Yeah,
Yeah. Yeah. And,
yeah.
and we might have one of these days coming up because the
The 90-day,
90-day pause is coming up
yeah.
here month and a half. So
I know
that'll be
us
interesting.
financial advisors, we're not looking forward to it. We're like, we just needed a break to regain our footing and to go back into this period of strong uncertainty. This is like nobody's asking for tariffs. Nobody wants this. So,
So, I mean, like, given the inflection point that I think we keep talking ourselves into, or that we think that we're already in, like, I keep wondering everything that's led us up to this point where, we stay in the market until we don't have to be in the market when we cash out as we retire, buying real estate, all of those things. So, in your opinion, and I'm asking this just not saying that, you recommend a certain stock because you like it. But in your opinion, it really is just like stay the course. We shouldn't expect anything different until that different occurs. And then at that point, everybody's pivoting to some new perspective, is my understanding.
right. And it's the whole current administration and the recent volatility, not just in the market, but just in American democracy. It raises important questions, right? Because you have people who are born into society, and then at some point, the society becomes a failed society. And this person had no idea that they were going to, at age 34, that the country they were living in and born in and knew their entire lives were going to collapse, right?
Mhm.
And they basically had to come up with a completely different game plan for their entire life to deal with this. And I can't say America is beyond that. right? We may be in a position where we're on the eve of something absolutely calamitous, and there's just not much we can do about it because we can't see where the final stroke will come, and we can't see what comes after that.
Yeah.
Um, I do get those kind of what if questions, what if, what if, what if. And I certainly understand. I've gotten a lot more in the past 6 months than I think I've gotten in my entire career.
Yeah. Yeah, no, I mean, I think the thing that I think about the most is just my Great Recession from the 2010s
Hmm.
when it was difficult for college grads to find a job because the bottom of the economy had fallen out, is this graduate version for people who are graduating in 2025. Their version of that is increasing artificial intelligence. And so
Hmm.
we're hitting upon another cohort potentially of professionals who may find it difficult to find a job because those jobs don't exist. And as a result, may find that their professional lives are delayed to start because
Right.
the opportunity to save money and have that long time horizon that the generations prior to them were able to afford and enjoy.
Hmm. And it's a fair enough question, a fair enough assessment. I do believe we are going into a different stage of capitalism.
Hmm.
And it's kind of like, is capitalism the answer when you have a 50% unemployment rate, right? Our unemployment numbers doesn't really capture the true unemployment rate in America, right? It's a
Yeah,
very
U6
curated
is
number.
not really it. If you
Yeah,
look at that, um, that's only the rate for people who have reported that they are no longer looking for work. Uh,
right,
I believe it is the uh, let me see. It's a U3 that is the total unemployed, which
right.
actually, no, the U3 is what people care about. That's the official unemployment rate, which as of April is 4.2%. But the U6 is the total unemployed. And if you look at that rate, that one's at
Yeah.
7.8%.
Yeah. And here's something that's really terrifying about American society that most people don't realize. Probably 80% of the spending in American society comes from maybe 20% of the population. Like it's
Mhm.
what Pareto's principle of America. And so when you look at capitalism and how it's parsed out, especially by this administration, they really only care about the 20%, right? That's spending the money and paying the taxes, right? So what happens to the rest of the population that's unable to spend and that doesn't pay taxes?
And when they go off the rolls and nobody's counting them anymore.
Right. Nobody counting.
Yeah.
There's a bigger picture going on here with the economy. And so there will have to be a restructuring of capitalism. It's just going to reach a critical mass where it's just not going to work. And I think we have a slightly bigger issue to address.
Yeah. Yeah. All right, so some more questions. What's your opinion about independent financial advisors versus advisory services offered by investment companies, especially when qualifying for higher tiers of advice, thanks to substantial investments?
Sure. So I started off my career at Edward Jones, in one of the investment wirehouses, broker dealers. And then I became a private wealth advisor at a private wealth firm when I left Edward Jones. Um, the thing that you have to look out with some of the wirehouses or broker dealers, and that's like an Edward Jones, Morgan Stanley, Wells Fargo, Chase, these major companies, is how they are compensated. Is the person being compensated by selling you products, right? Because it creates an incentive in there to put you in products that may not necessarily be in your best interest, but have the highest profit to the financial advisor. Now, I worked for Edward Jones for 6 years, and I will say, hand to God, I never did that to a client. I, never put people into products I didn't think were appropriate for them for a buck. But you could see where the incentives were sometimes created for people to do just that. If a person is an independent advisor, and I'm now a registered independent advisor, we're not compensated through sales anymore. Like I'm on salary now, so I really have no incentive to sell people anything or put people in a product that doesn't make sense for them. Um, If you're looking for somebody who can manage at a very high level, I would look at the years of experience. And I would also, there's a website, Broker Check, where you can check the person's background and make sure that they are licensed, brokercheck.com, and make sure they don't have any adverse marks against them because there are some advisors out there with wild pasts that you don't want to you don't want them as your advisor because they have several bankruptcies and several pending cases against them, and you can find that out on BrokerCheck. I would also look for someone who is a certified financial planner, a CFP. Because to become a CFP, you have to do, I think it's like like equivalent to 1,000 hours of like classroom training. It's equivalent to like 7,000 hours of documented practice, an 8-hour exam, and we have to do ethics and constant continuing education to train. So I would just look at that person's background very closely. But some of the best advisors I've met have worked for like a broker dealer like Edward Jones. And there's some great advisors on the RIA side, yeah, too.
Great. Oh, we have another question. To invest in a bond, would you recommend investing in US bonds or world bonds based on the current situation?
Okay. So I can't recommend specific bonds, but I will say this, bonds are infinitely more complex than stocks, right? They're a lot more complex because they function in a completely different way than stocks. The US bond market traditionally has been pretty strong and is backed by the US dollar. And there are international bonds that are denominated in US dollars as well. Um, what is the factor of what I'm willing to invest in the bond market is the level of risk, right? Because certain currencies, especially if you start going into foreign currencies, you're not, it's not just the bond, but it's also the currency risk over time. And so, if you look at what the bond market is doing right now, a lot of the action in the bond market is still happening inside the US, even with US Treasury bonds. In the last kind of kerfuffle in the market during March and April, usually when there's uncertainty, there's a rush to US Treasuries. We didn't see the same rush to US Treasuries that we've seen in past years, which is a little bit troubling. But, the US Treasury is still the bond of choice for global reserve of currency, both domestically and internationally. So most bond traders, when given a choice, will do a domestic over an international for all those factors.
Yeah, we've heard a lot about the bond market over the last couple of months, in particular as the tariff trade has become a big issue, and that people have become increasingly concerned about the bond market because there is a correlation,
Mhm.
right? When the three and the five when the I think it's when the 3 year and the 10 year invert, that
Yeah.
also is one that brings a lot of concern for potential recession.
Yeah.
Uh, can you
And
can
it,
clarify that I'm maybe saying the right thing
well,
or
it's inverted before and it didn't lead to recession. So it's been in recent years, there has been points where it has inverted and it hasn't portended, but it's still the bond market has become even more complicated in the past 10
yeah.
years or so. And the reason why there's been like a recent kerfuffle in the bond market is because Moody's downgraded the US Treasury, right?
Mhm.
It had like the super primo best rating, and now it's like just under super primo best. The US Treasury bonds have been downgraded before in the past. So this isn't anything new or different. And in the financial world, we kind of knew it was coming, but it's troubling because the US currently is in so much debt, right? And Donald Trump's current tax bill will deepen the deficit,
By
right?
2 trillion.
And if our bonds are being downgraded, a lot of our debt is held through treasuries. Um, it raises the question, are we going to be able to pay the interest on this debt? Because
Mm.
we're digging the hole deeper. Our bonds are being downgraded. It's not a good look. It's not a good look.
So talk a little bit about that. How will our downgrade of our bond about our bond market by Moody's impact, let's say, the everyday American's ability to borrow money, to be considered for credit cards, and everything along the way,
Yeah.
especially if they're unemployed right now and possibly trying to figure out where their next opportunity will come from.
Well, and this is going into bonds and inflation and interest rates. So it's all tied together, right?
Yep.
And Albert, you and I are both homeowners. We bought our homes within very close proximity. I think we closed within weeks of each other.
Yep.
My interest rate sucks. I'm at 6 1/3, right? And when I bought my home, the real estate always tells you buy the home or marry the home and date the rate, right? You can refinance at some point in the future. Well, I thought when I closed on my home in October 2023, I could refinance because interest rates were portended to come down in 2024. So if I could get my interest rate under 4% or just at 4%, I would save $500 or $600 a month, right?
Yep.
That hasn't happened. I'm stuck at 6 1/3. We're mid 2025 and I'm stuck at 6 1/3, right?
Which,
Um,
you know what, compared to when our parents bought at
it's
13% in the
true.
mid 80s, doesn't seem so bad.
It doesn't seem so, but our parents also weren't buying a $750,000 home.
No,
It,
no.
so
Homes were half the price, but double the rate.
yeah, yeah. So it sucks, right? If I could free up that $500 to $600 a month, I would be spending it in the community and in the economy. That money would be circulating,
He'd
right?
be going out to dinner, he'd be
Yeah,
buying clothes and doing that whole thing, going to farmers
yeah.
markets. Yeah.
Yeah, but now I can't do that because it's locked in this house, right? So that's an example of like interest rates, bonds, and inflation, how it's tying together. And Jerome Powell, the chair of the Federal Board, basically he said that there would potentially be two interest rate cuts later this year. Everybody's holding their breaths on that, and the market has already kind of built that into its model.
Yep.
And it basically frees up more capital to circulate in the community and in the market. The problem with that is tariffs are inflationary by
Mm.
nature, right? So if we have tariffs that are causing inflation, making things more expensive, you don't really want capital circulating in the community because that feeds inflation,
Yep.
right? And we're potentially faced with a situation of stagflation. And I don't think anybody on this call remembers stagflation. The last period of stagflation we had was during the late 70s, early 80s, and it was terrible. It was when inflation was really high and we were in recession. So things were getting really, really expensive. A lot of people were unemployed and recession was raging. It's really hard to fix that once we go into a stagflation. And that's what Jerome Powell is concerned about with Donald Trump's tariffs is going to kick off a round of stagflation. He was asked directly at the last chair of the federal board's meeting, if we go into stagflation, what is the bigger fire? Like, what are you going to fight? Are you going to fight the recession or are you going to fight inflation? And basically he said, I don't know, whatever one's the bigger beast. We fight the bigger beast first, which is a little bit disturbing, but I mean,
Yep.
that's pretty much all that they can do. So you're either going to be dealing with inflation or you're going to be dealing with a recession or you're going to be dealing with both.
Yeah.
So
And there's no good way out of that
there's
either.
no good way out of that. So I didn't give a direct answer of how bonds are tied into this, but it's tied into this whole inflation interest rate bond thing. And so what bonds are doing, it seems like something very obscure and maybe it's only applicable to like institutional investors or but no, it affects you every day. It affects inflation, it affects how much you pay on your mortgage, it affects how much capital is circulating in our economy. And this whole tariffs discussion is tied into it.
Yeah. No, it's complicated and yeah, if it was a different election last year, election result, I would have said that interest rates would be starting to go down gradually this year and we'd see
Yeah,
the return of jobs. But
I
it's
would say
a
so too.
completely different direction. And so, uh,
Yeah.
like you, I can't really tell people what's going on the remainder of the year. I just tell them that, there's certain things that they can do to put things more in their control. And that includes, what they can do with their money.
Yeah.
Yeah.
Yeah, that's where we're at, unfortunately. And I've had many similar conversations with clients who are very concerned. Some of my very wealthy clients are doing the golden visa,
Okay.
but
Okay.
these are people with millions of dollars. So
Yeah, if you have $500,000 to go spend in Portugal, then,
yeah, and you can do a golden
absolutely.
visa too.
Yeah,
Yeah.
absolutely. Absolutely. All right. Any other questions from those of you here? You have some exclusive time with a financial advisor. Ask the question you've always dreaded asking, or ask the question that you'd have no idea what the real answer is, and let's get some perspective. Yeah. So, yeah, it's and Friday we get the labor report
With
as
the labor
well.
report, yeah, I don't think it's going to be looking that good. So, there's definitely going to be probably some volatility in the market around the labor report.
Yeah.
Um,
I have
so,
an ongoing bet with the professor who does our monthly jobs report and inflation update on when we'll see the first negative jobs report. And
mm,
we were saying sometime by the middle of the year, so
yeah,
see, it's hard to say.
yeah, yeah.
Yeah. All right. Well, if there are no other questions, I would love to get some final thoughts from you, Robin. Any last insights? Maybe one thing that anybody should take away from this, given where we are in the market right now, and what they should do with their money.
Right. So I know we're on uncertain times, right? And a question just came through. We'll get to it after I say
Oh,
that. I know we're in very uncertain times. I know that a lot of the media about what is happening is very scary. It's okay to turn off the television. It's okay to take the app off your phone. It's okay to say, I'm not going to open my statement this month. But what's most important is often to hold the position and don't panic sell, don't panic do anything. Make sure you have cash and keep that cash on the side. But holding the position, I will say 100% of the time I've been a financial advisor, it's always been the right decision.
yeah, good. Yeah, Vikram asks, I'm looking to pay down credit card debt. Every day I get called from some organization or another. Are they legitimate?
So if you want to pay down credit card debt and if you want to refinance, I wouldn't let someone reach out to you. I would reach out to them.
Okay.
Right? Because there are a lot of scams and there are a lot of shady operators out there that are looking to reel you in. The best place to look to pay off credit card debt is to call the credit card company itself. And if you have good credit and you have a good history of payment, you might be able to negotiate down that interest rate. Or you might be able to say, look, I just need a lower interest rate for the next 6 months. Are you willing to work with me and give me a lower rate for 6 months? And sometimes they do it. Sometimes they do it.
Yeah, you never know until you call and ask them.
Closed mouths never get fed in the world of finances. So always ask.
Oh, I like this one. How should one think of sequencing their financial goals? Home ownership, children, entrepreneurship, etc., while maintaining long-term wealth.
Okay, that's a big question.
Yeah, and I mean, I would ask this. I would ask a semi different version of that is in this type of economy, what is your perspective on even having a child and starting a family,
Yeah.
knowing that, things will look drastically different with AI, automation, geopolitical issues, and potential de-dollarization in the next 21 years.
Yeah. I mean, it's a big question and it's a very personal question, right? Because deciding whether or not to have children is a very personal issue. And it's a very visceral issue, and it's not something I could tell someone to do or not to do as a financial advisor because some people really feel the need to have children and, want to have a family no matter what. Our parents faced extreme hardship. Like when I was born, it was during the era of stagflation, right? And it was 79, 80. My parents had a kid anyway. They were paying 14% on a mortgage. They had a kid anyway, you know. And we certainly had our struggles, but we turned out fine. And I know things look very uncertain and feel very scary at times, but you have to have faith that your kids will figure it out over time. Your family and your kids will figure it out over time. Going back to the question before of how to basically sequence your life, um, it's hard because things are so gosh darn expensive. It's not like you can run out and buy a house at 24, right? Most 24-year-olds don't have the economic security to have children, right? So that kind of pushes everything into maybe your 30s, right? You
I mean,
know,
the
and
average age of the average home buyer these days, it's like in the 50s, right?
yeah, I mean, I was what, 43 when I bought my my home. My
Yeah.
parents were 25 when they bought their first home.
Yeah.
It may be that you when you have your first child, you don't own a home and you have to be okay with that. I see that more and more often. People who don't own a home who have a child and
Mhm.
they just get a bigger apartment, you
Yeah.
know, because they're having a child is time bound, right? Most people don't want to become a parent at 50. So, yeah, like there was Joy Bear, who's a celebrity, bought her first home at 50. So the life cycle is getting extended out, and don't feel like you have to do everything before 35 because that's not realistic for the vast majority of people.
Yeah.
Like look at what is time bound and then do that for, I wouldn't wait until like 40s to have children because the odds of having a successful pregnancy without complication in your 40s, it's slimmer, right?
Yep.
You know, and you can read about that online. And it's not just for women, it's also for men. There's a lot of complications that come up in the 40s with children who have older fathers. So I would do some research on your goals and figure out which ones are time bound just by nature or by, your life and figure out how to accomplish those goals that are time bound first. And then the bigger goals like buying a home, you may be in your 40s before you get your first home.
Yeah. Yeah. And another follow-up question is it even advisable to buy a home these days, especially when you're older, 55 plus? To what extent would one's overall wealth figure into that decision?
Hmm. And that's a great question. Buying a home isn't the come up it used to be. And especially here in California, it has to do with issues of insurability, right? You can buy a home and once it's uninsurable, you can't sell it, right? So it's kind of brick the value of the home. It's also things, homes are so expensive. America really hasn't done a good job of building enough homes for the expanding population. So it's not the slam dunk, ticket to wealth that it used to be. But one thing I will say as a financial advisor, almost 100% across the board, by the time you retire, it makes sense to own a home because it stabilizes your living costs in retirement.
Yeah, I mean, look, you and I may be paying 6.3%, but at least you'll be paying that 6.3% for the next 28 years. And
Yeah,
what rent might look like in 28 years.
probably unholy expensive, And so it's for younger people, I don't push buying a home as it was a generation ago, but for my retirees, I try to get them in a position where they can own a home. And that may be buying a home somewhere else cash, when you retire, just to get out of rising rents and get out of that whole trap.
Yeah, yeah, yeah. Good questions, everybody. Thank you so much for asking. I asked for your final insights, Robin, and everybody started asking questions again.
Okay. I mean,
Glad
I'm
that-
willing to stick around for a few minutes if people have any additional questions. You guys ask great questions.
Yeah, and here's Robin's LinkedIn again, so feel free to connect with her.
Mhm.
Um, I think it's one of these traditions where I have you on once a year, and it's really interesting because I think it just it's interesting to see how the whole entire market changes from year to year. So
hmm
um,
hmm
yeah,
Yeah.
yeah,
Well, I'll be happy to make a return next year. And thank you,
yeah.
everyone.
We'll see
You've
you
been,
back here next year. It'll be
yeah,
fantastic. Maybe we
you
have
guys
you
have been a great
earlier.
audience. Yeah.
All right. Well, we want to thank once again, thank Robin. Put your thanks in the webinar chat. We have recorded this, so if you did enjoy this webinar, it will be on our link on our not our LinkedIn. It'll be on our YouTube for further watching and rewatching. And we also have plenty of other events coming up on Albert's list, so feel free to go back into Eventbrite or Meetup or wherever you came from, and we will see you here again very soon. Thank you
Okay.
all so much, and have a wonderful evening.
All right.
Goodbye.
Thank you. Thank you, Albert.
Thank you.
Good night.
Bye.